Welcome to IP Data's update on housing market conditions for August 2014, brought to you on behalf of National Australia Bank. Dwelling values continue to trend higher in July, with IP Data's combined capital city index moving 1.6% higher over the month, taking the quarterly trend rate of growth to 1.1%. Growth across Australia's capital city housing markets remains a very Sydney and Melbourne-centric phenomenon. Values were 2% and 1.8% higher in these cities over the 3 months ending July, while each of the remaining state capitals recorded a drop over the quarter. Brisbane values were 0.4% lower over the rolling quarter. Adelaide housing saw a 2.6% fall. Perth values were down 0.1% and Hobart market recorded a 1.2% fall in values. The territory capitals fared a bit better, with Darwin recording a 0.8% rise in dwelling values over the 3 months to July, while Canberra values recorded a 2.1% increase. The annual results highlight the very strong growth conditions that have been evident in Sydney and Melbourne. Sydney values are up 14.8% over the past 12 months, while Melbourne has seen an 11% rise. These are the only two capital cities to record a double-digit growth rate over the past 12 months. Underpinning the strong growth conditions across Australia's two largest cities have been consistently high auction clearance rates, low levels of advertised housing stock, and consistently strong buyer demand. Clearance rates in Sydney have remained above the 70% mark for all but 2 weeks so far this year, with recent results across the auction market tracking around the 75% mark in Sydney. The Melbourne auction market's almost as strong, recording clearance rates around the high 60 and low 70% mark over recent months. Auction results are less important across the remaining capital cities, however other vendor metrics paint an interesting picture. The average number of days it takes to sell a home in Sydney and Melbourne is the lowest at just 30 and 41 days on average, indicating that homes are still selling quite rapidly. Every other capital city apart from Darwin and Hobart are seeing homes sell in less than 2 months on average. Vendor discounting rates are quite different though, with Canberra vendors discounting the prices the least at just 4.4% on average from the initial listing price in order to make a sale. We've seen listing numbers in Canberra fall substantially over recent months, with the low stock levels and more realistic initial asking prices potentially keeping discounting rates low. Hobart and Brisbane are showing the best opportunities for negotiation, with initial asking prices being discounted by 7% and 6.2% on average, the largest discounting rates of any capital city. Listing numbers have moved even lower compared with a year ago, making it more difficult for prospective buyers to find a home and drive a hard bargain at the negotiation table. Nationally, there are almost 10% fewer properties on the market compared with a year ago, and across the capital cities, there's 13% fewer homes being advertised for sale. Listing numbers are likely to ramp up during spring, which will provide a real test for market conditions. Let's have a look at the housing market across each of the capital cities. Sydney dwelling values were 2% higher over the 3 months ending July 2014. Homes are selling the fastest of any capital city at just 30 days on average, and listing numbers are about 16% lower than a year ago. Sydney dwelling values have risen 14.8% over the past 12 months, and the cumulative value growth over the cycle to date reached 24.9% in July. While capital gains remain strong, the rate of growth has been trending lower, with natural affordability and low rental yields likely to be the main disincentives to purchase in this market. Melbourne's housing market recorded a 1.8% rise in dwelling values over the 3 months to July, with the capital city gain entirely concentrated within the detached housing sector, where house values were 2% higher over the rolling quarter. Apartment values were unchanged over the 3-month period. A similar performance between Melbourne houses and units can be seen over a longer period, with house values up 11.7% over the past 12 months compared with a 5.5% rise in unit values. Confidence in the Melbourne market may have been dragged lower by the large number of new unit developments approved for construction in recent years, as well as low rental yields compared with other cities. Housing market conditions in Brisbane continue to underperform Sydney and Melbourne, with dwelling values slipping 0.4% over the 3 months to the end of July. The longer-term trend is still one of sluggish growth. Brisbane values have moved at 6.9% higher over the past 12 months, with the local unit market showing a slightly higher rate of capital gain at 7.4% compared with house values, which were up 6.9%. Rental yields remain higher than the other major capitals at 4.5% gross for houses and 5.3% gross for units. The higher rental returns, better affordability and earlier stage in the growth cycle are likely to be key factors driving a stronger performance across the Brisbane market in the future. Adelaide's housing market recorded the weakest conditions of any capital city over the 3 months ending July 2014, with dwelling values down 2.6%. The fall was centred within the detached housing market, where house values were down 2.8% over the rolling quarter compared with a relatively flat apartment market where values were 0.2% higher. Over the past year, Adelaide dwelling values have increased by 4.3%. Despite the relatively soft conditions, year-on-year transaction numbers are up 9.5%, suggesting buyer demand is growing. The rate of capital gain across the Perth housing market continued to ease in July, with values drifting 0.1% lower over the rolling quarter. The Western capital commenced its growth cycle much earlier than most other cities and moved through the peak of the cycle in late 2013. Year-on-year transaction numbers were down 1%, indicating a slowdown in demand. Rental markets were also tapering, with weekly house rents dropping 2.2% over the past year and unit rents virtually flat. The upwards trend in Hobart dwelling values has been interrupted over the past 3 months. Hobart dwelling values were 1.2% lower over the 3 months to the end of July, driven by a substantial 5.5% drop in the apartment index. Rental yields across Hobart are showing a healthier reading than most of the other capital cities, indicating that the payment gap between buying and renting a home is much narrower than many other capitals. Hobart houses and units are providing a 5.2% gross return on average. Darwin's housing market recorded a 0.8% rise in values over the past 3 months, influenced by a 5.6% quarterly rise of unit values compared to a 0.3% fall in house values. Buyer demand has flattened out across the northernmost capital city, with transaction numbers virtually unchanged over the past 12 months. Darwin continues to show an impressive yield profile, with houses recording a 5.9% gross yield and units showing a 5.8% gross yield. The rolling quarterly rate of growth in Canberra ticked up over the past 3 months, with the local dwelling index increasing 2.1%. The longer run trend, however, has been much softer. Canberra dwelling values are up just 1.9% over the past 12 months, and transaction numbers have fallen by close to 2% over the year. Most of the fall away in buyer demand has been centred within the apartment market, where transaction numbers are down more than 15% over the year. In summary, the housing markets recorded a diverse performance from region to region and across the product types. The winter months have been surprisingly strong, though, across Sydney and Melbourne markets, where growth has been nation-leading over the past 2 cycles. Since the beginning of 2009, Sydney values have risen by 47% and Melbourne values are up 45%. The byproduct of such strong capital gains is lower affordability and compressed rental yields. The rate of growth in these markets, while strong, has been tapering, and this trend is likely to continue as the nation's 2 largest cities move back to a more sustainable level of capital gain. The growth in housing finance commitments has also peaked, reflecting a slower pace of mortgage demand that will reflect a slowdown in the pace of buyer demand. The annual change in the value of owner-occupied housing finance commitments peaked in November last year, and investor housing finance commitments peaked in December last year, foreshadowing a peak in transaction growth. Low consumer sentiment readings, which are slowly improving after the federal budget announcement back in May, are also likely to dampen housing demand. Consumer confidence and housing market trends are highly correlated. Population growth is also slowing nationally, which will inherently drag buyer demand lower as well. Fewer overseas migrants, particularly within the mining states, are the primary driver of a slower rate of population growth. The counterbalance, of course, is low interest rates. The general consensus amongst economists and financial markets is that the cash rate is on hold for the foreseeable future. The low cost of debt will continue to be a primary driver of higher home values across Australian markets. Once again, thanks for tuning to RP Data's Housing Market Update. For more information on housing markets, check out our research blog, our Twitter feeds, and the RP Data website at www.rpdata.com.